Welcome back to the PI World Education Series on getting your children interested in investing. And I'm delighted to be back with Edmund Shing, who has successfully achieved this and joins us to share his experiences. As we said before, Edmund's a parent, the Chief Investment Officer at BNP Paribas Wealth Management, an accomplished investor and author of The Idle Investor on how to invest 5 minutes a week and beat the professionals. So a fountain of knowledge and experience to guide us on this series for parents, their children, and probably more broadly anyone who wants to start investing. Thank you so much for joining us again, Edmund. Now, in your book, you talk about predominantly ETFs, but let's start back with funds more broadly. One has a choice of whether to invest in funds or in stocks. And if we start with the fund route, you've got the choice of managed funds, investment trusts, and ETFs. What's your thought on using funds and those three options?
I do think funds are an excellent way to start investing. For someone new to investing, funds are an excellent way to get some sort of diversified exposure, because you're not picking one stock and putting everything on black, as it were, but you're spreading your money out amongst a number of different stocks or bonds, and that's always advisable, particularly for newer investors, because it does spread the risk a little bit. So I think diversifying out your risk is important, and for that reason, I do like those funds. Now, between the choice of those three categories, ETFs, investment trusts, and let's say managed funds, unit trusts, let's say, I'm much more a proponent of using investment trusts and ETFs. So why don't I like unit trusts? And I think that the answer is quite simple. If you invest for yourself via a platform provider like an AJ Bell or Hargreaves Lansdown, they charge you to hold funds. I don't know why. I actually don't see any logic for it, but they actually add an extra charge. So not only are you paying the fund manager's charge for managing the actual fund every year, but you also pay the platform provider for, I don't know why, but you do. So you pay two charges, not one. Now, if you buy an ETF or an investment trust, you pay the management charge yearly, but then all you do is you pay one-off charge to buy the investment trust or ETF, because they are basically shares. So just like you buy any other share, you pay a one-off fee, and that's it. Then you only pay the one fee a year. And particularly for ETFs, the fees tend to be very low because they're passive vehicles. So there's literally probably one bloke in his computer managing that, and you really don't need to pay them a lot of money, but they're following an index. That's all they're doing, copying an index. Now, in many cases, that's great. If you're thinking about the S&P 500 or the FTSE 100 or FTSE All Share, that's fine, because that's a very broad index and it represents the whole of the vast majority of the US stock market or the vast majority of the UK stock market. If that's what you want, it's a great alternative. But there are some areas of investment where actually you would be better off with an active manager, such as for small caps, Japan, emerging markets. There are a number of areas. Now, in these cases, I really do like the investment trust approach, because you buy an investment trust like a share, you don't incur this extra fee, but you get the benefit of an active fund manager picking the good shares and hopefully avoiding the bad ones. And in these sorts of areas, just avoiding the bad ones can make a huge difference to the overall performance of the fund.
And why would you use a managed fund?
I would only use a managed fund like a unit trust where I absolutely cannot find the exposure either via an ETF or through an investment trust. So in actual fact, personally speaking, I have not used any managed funds at all. I've managed, because the beauty of ETFs, of exchange traded funds, is that there is such a wealth of them available today, covering not only stocks and stock markets, but also bonds and credit and a lot of other type of vehicles. So actually, you can find lots of different types of exposure via exchange traded funds at very low management fees. So that's why I always bias towards ETFs, and I think there's a huge spread available. But even in the investment trust universe, there are an awful lot of them as well. There are hundreds of investment trusts available, which cover a lot of specialist areas, which perhaps are not covered by ETFs. So I generally find between the two, I don't need to resort to managed funds outside of investment trusts because I find I have enough choice already.
And when you're looking at these funds and where to invest, are you looking at collections of stocks and equities, or are you looking at bonds? How are you diversifying the risk when a young person is investing their very precious little pot that they're trying to invest?
Well, I think it's very important, like with any investor, the first question you have to ask yourself is what is the purpose? What is the goal? What is the objective? Now, for a young person, well, like my children, the idea is to make their money grow over a long period of time. So, again, the earlier you invest, the longer they have before realistically they're going to need to tap into the pot. So what I said to the kids is, look, try not to touch the pot until, let's say, you are about to buy your first house or flat. That's a good reason to touch your pot. Until then, don't dip into it. Just leave it. Let it grow. Because the longer you leave it, the longer you let it grow, the bigger it will become over time. So that's important. Now, as a result of that, your objective is long-term growth. So if it's long-term growth, why would you invest in bonds? Bonds are good for diversifying. They're good for, well, they used to be good for income, but they're not really good for growth, right? They're just government IOUs or company IOUs, which pay an interest rate, but they do not grow. The interest rate on those bonds can never grow. So over the long term, the growth is going to be found in equity. So I've always pushed the kids to invest in ETFs or investment trusts based around shares, because that is where the long-term growth is, as opposed to bonds.
And then how do I select an ETF or an investment trust? I take my pot and I want to diversify it across various funds. How do I select what I do with it and how many funds I should have? And then what do I look at for each of those funds in order to know that's the right one to put my precious money into?
These are very hard questions because there are just so many choices, so many possibilities. And actually, even with funds, even with ETFs and investment trusts, there are just so many of them today that actually that in itself becomes an almost impossible task. It's like it is at least as bad as trying to pick stocks, in that there's just so many choices. And it's interesting that there's always this discussion between what we call active and passive. So on the active side, those are people trying to pick the stocks that are going to outperform. The passive is you just buy the index because we don't believe that people can pick stocks that outperform in the long run. Okay. Now, in reality, there is nothing that is truly passive because you're always making a decision at some point as an investor. As you said, even if you decide, well, I'm only going to buy indexed ETFs, right, based on indices, with no one picking the stocks, just the computer putting the stocks together. You still have to, as you say, you still end up saying, well, which indices am I going to buy? Am I going to buy the US? Am I going to buy UK? Am I going to buy Europe? Am I going to buy some bonds? Or am I going to stick with stocks? These are all active choices that are unavoidable. So the problem is we always have to choose. And that for a new investor is a very difficult question. And so I always argue that you should go for a nice widespread of investments, geographically speaking. So, because the biggest problem, the biggest mistake, I should say, in quotes, that people make as investors is they have too large what we call a home bias. They invest in what they feel comfortable with, and that's usually the shares or funds based on their own country. So in the UK, it is we're buying too many investments, trusts, or ETFs based on the UK, and we're not putting enough money overseas. And this is true. I mean, they've done studies on this, and this has been shown to be true for investors in every single country. You, of course, are biased towards your own country, and that sort of makes sense because you feel you know your country and the stocks in those country better. But in reality, is that really true? And I think that's a dangerous assumption to make. We are implicitly making that assumption, but I think we need to force ourselves a little bit out of our comfort zones because in the long run, that tends to be better for diversification, better for our investment for performance overall, to look overseas, to look to the US, to look to emerging markets, Japan or Europe, for instance. I think we do need to force ourselves to do that, and also to diversify amongst asset classes, to look maybe at bonds or corporate bonds, to look maybe even at precious metals, gold and silver and so on, or other commodities. Now, people think, ooh, I don't know about that. Well, again, these are real diversifications, because these are the sorts of assets that can go up when stocks go down, which is sort of what it's about. When stocks are going up, if you invest in stocks, that's great. But when they're going down, you'd be quite happy to be invested as well in something else that isn't going down along with stocks, but might even either hold its own or might even go up at the same time, because then it sort of hedges out your stock risk, as it were. And I think that sort of balancing out your portfolio so that it's not all on black or all on red is probably quite a good idea. So I think combating that home bias and spreading your diversification a little bit, not just in 100% in stocks and shares, those are the two areas I would start with.
So when you're looking at an ETF, how do you judge whether that's something that you want to buy in? Obviously, what it says on the tin, sort of hitting the American markets or the S&P or whatever it is that you want to get into. But beyond that, what criteria should I be looking at with an ETF?
Well, there are basic things like, for instance, the size of the ETF. Now, you think, well, why should that matter? Well, it matters because liquidity is important, as it is for single stocks. It is the same for any funds or ETFs as well, because sometimes what happens is the ETFs start very small. And so what you find is the spread between the buying and selling price are actually surprisingly wide. And so it's not just the charge you pay, but it's that spread you pay between the buying and asking, the bid and the ask, or the buying and selling. So that is an important consideration. So the bigger the fund, typically, the better the liquidity, the tighter or the smaller the difference between the buying and the selling price. So that's a very important point. Another important point is, as I said, it makes sure it says what it does on the tin, because sometimes the names of these funds can be a little bit deceptive. So I think the most important thing with an ETF is always look at the fact sheet. Read, it's only a couple of pages, but just flick through it and make sure it is what you think it is. Because there have been some occasions where the name is deceptive and the actual fund does not do what you think it does, or does not invest in exactly what you think it does. So it's very important to check that. And I think, for me, those are the two most important things. Then you might look at the annual management charge to make sure that is reasonable. Again, it should be low. Otherwise, what's the point of investing in an ETF? Again, it's just one bloke in his computer. So the charges should not be high. They should be really much, much lower than for an active fund. They could be as low as 0.05% per year. I mean, really tiny, but it should certainly not be more than 0.2 or 0.3% per year, unless it's a very specialist area. Because again, remember, the one thing, we cannot control our investment performance. We have no idea what the markets are going to do, but we can control the investment cost, because we can see that. That is known. So obviously, the lower the cost, the better for you in the long run.
And are there any brands as such in ETFs? There are some larger institutions that run a lot of ETFs. Are there any sort of trusted brand names amongst ETFs that we should be more inclined to invest in?
Well, the biggest ones, Tamsin, are sort of, for people who look at ETFs, are fairly obvious. So iShares from BlackRock. BlackRock is one of the biggest fund managers in the world. I think they are the biggest, together with Vanguard. So BlackRock is a very trusted name, because they're all over the world in active funds, and also the biggest in ETFs with their iShares brand. Secondly, Vanguard, which is another very big US house. But again, interestingly, with Vanguard, the thing to note about them is they're a not-for-profit organization, which is quite unusual. And so as a result, they tend to focus on index funds that are very, very cheap. So they're good because they really do try to keep their costs as low as possible. Otherwise, in European brands, well, there's actually a very interesting one called Amundi, which actually is French, but again, has a wider and wider range of European ETFs available in the UK, just as everywhere else. And again, their focus has also been on keeping fees very low. So I do like, and they've got a really quite a wide range. So I think those three stand out to me as very interesting, trustworthy brands. There are many, many more, of course, but I think those three are, three of the biggest ones to take account of as a beginning investor.
And with investment trusts, what am I looking for there?
Well, again, you're looking only in certain areas. So as I said, first of all, if it's a US large cap fund, why are you even bothering the investment trust? If, however, you're looking at Japan, then there are a number of active managers that have done very well in Japan, vastly outperform the benchmarks over a period of time. So I would say with investment trust, first of all, look with either for an area where you can't find an ETF that does the job, or find an area where active managers have been shown over long periods of time to outperform. As I said, small caps, emerging markets, Japan are just three areas. You might also look for certain areas of distressed debt or specialized credit, for instance. These are things that investment trust vehicles do that ETFs do. One other interesting fact about investment trusts is that the fund manager can sometimes even use a limited amount of gearing. So that means they can even borrow some money to invest a bit more than 100% in the fund. Now, that can also help boost the returns a little bit. I mean, again, only to a limited extent, but it is something peculiar to investment trusts. And for those investment managers that can use that wisely, that can actually help the long-term returns as well. So I think these are the reasons I would be looking for investment trusts in a number of these areas. And I particularly like, for instance, in small caps, because small caps, there are so many of them. There are so many of them. And an index that covers small caps will invest in a lot of not very good companies. Whereas a fund manager can just exclude 90% of the small caps, focus on what he or she considers the best 5 or 10%, and put the money there. And doing that can sustainably outperform the broader small cap indices. And that's something we've seen time after time after time. So particularly with small cap investments, I do like investment trusts and investment trust managers.
And who do you consider the best investment trusts in the sector?
Well, that's a very good question. There are so many of them, but I mean, there are a few that spring to mind. For instance, Baillie Gifford, funnily enough. Baillie Gifford, I mean, they've been very growth oriented, but they've done very well. And I'm not just thinking of the Scottish Mortgage Trust, but I'm thinking of things like Baillie Gifford Japan, for instance. Excellent track record of beating the Japanese Nikkei 225 over a long period of time. So if you want to invest in Japan, they're a very good place to be. Montanaro, some of your viewers will have seen and listened to Charles Montanaro in the past. Very interesting person, but again, his fund management outfit based in Scotland have a very good track record on small caps, UK small caps, European small caps, particularly actually in European small caps. So if you're looking in that area, that sort of investment manager can be very interesting. Elsewhere, particularly when you look at things like venture capital trusts, which are within investment trusts, the growth area, Amati is an interesting name. So I mean, again, they're quite specialized. They do different things well. They don't all do the same thing well, but there are a number of names that pop up as being very interesting specialists in these different areas.
Now, in your book, Idle Investor, you've got 3 different methodologies for investors to follow. And actually, they're very, very simple, mainly comprising of just taking 2 ETFs and investing in those over time and using time a little bit. So with this investing for your children or your children learning to invest, how many funds would you suggest they start off with their small pot of money?
Oh, just 2 or 3. Just 2 or 3. They could even start with 1, because you could just take the simplest approach and buy what I call a FTSE or an MSCI all-world fund, which literally buys all the stocks, all the big stocks in the world: US, Europe, Japan, emerging markets, UK, all in one fund. And the beauty of that is, so not only do you capture companies from all over the world in one fund, but of course, because it's an index and an ETF, very cheap. So someone like Vanguard will do one, iShares will do another one, Amundi will do one. They'll all do them, and they'll all be very cheap. So in fact, you could even just start with one fund if you really wanted to. But I would always recommend start with the all world, or like a world ETF, investing in companies from all over the world. That's an easy way to start. Otherwise, I would say 2 or 3. And the reason I say 2 or 3 is because I wanted my kids to be focused on growth. And so we're looking for growth markets. So that could be the US, particularly US technology, for instance, because that's something that has grown very well. Another area I really like is healthcare. So I do like ETFs that focus on the healthcare sector, because again, over the very long term, that has proven to work very well for growth purposes, and also because we're all getting older, And healthcare, healthcare costs start to go up very, very quickly as we get old. So again, as we're aging, I think healthcare will become more and more important, will become an even bigger slice of the economy. And so it's always good to sort of position yourselves in areas of the economy which you think will become bigger over time. So that's the sort of way I've tried to position my kids with their investments.
And in terms of engaging your children, in the last episode, you were talking about Warhammer and that being quite a story that engaged your son. Are funds as engaging as individual stock picks, or have you found it easier to get them interested when you're talking individual stocks?
That's a very interesting question, Tamsin. So I think for general funds, it's difficult to get passionate, isn't it? If you say the US or Europe or the UK, yeah, well, that's a big amorphous mass, right? So that's difficult. What's a story? It's difficult to create the story to get them excited. So the way I've done that is use thematic ETFs, because the beauty of exchange traded funds as well is there's a very fast growing segment of exchange traded funds which are dedicated to individual themes. So I actually mentioned one last time, which was medical cannabis. Believe it or not, there is a fund called the Wellness and Medical Cannabis Fund, ETF, and it invests in a broad swathe of companies that are focused in this area. So that's one way of actually, targeting or zooming in on a very specific theme, and then buying a fund, buying an ETF that is focused on that theme and buys a basket of companies which are all related to that one theme. And that's the way I do it. So I pick that, or for instance, video games is a great one. There is a video game ETF run by Vanek, which has been very popular. And of course, video games, it's not difficult to get my kids interested in video games, because yes, we all have played them. I've played them in the past, and my kids play them now. And so they understand. They very much understand the dynamics, and they can see that the future of entertainment is moving away from TV, classic TV or classic radio. It's all moving towards not just streaming, but all moving towards video gaming. And video gaming is taking a bigger slice of our overall entertainment budgets. They can see that. They're part of it. And so, again, getting them interested in a video gaming ETF is very easy.
And when do you think they can start graduating to selecting individual stocks rather than selecting a fund?
Quite quickly, actually, quite quickly. But I don't think it's an either or, Tamsin. I think you can do both. I think you can introduce a few stocks alongside your funds over time. And that's what we've done. So they started with funds, and then bit by bit, they've been either using new money, or even selling a bit of their funds to invest in single stocks gradually. Because I said to them, look, investing in single stocks is great. It can really be very interesting, and also can make you good money, but you need to do your research. You don't want to rush in, and you mustn't listen to stock tips. I said, don't ever listen to someone else's stock tips. We've all done it. And let me tell you, and I said to them, I've done it too, and it's a big mistake. Those four letters DUIO, do your own research. My goodness me, I've paid for that many times over with my stock tip mistakes. And so, yes, you must do your own research. Take your time, dig around, make sure you're comfortable with the idea and you understand the idea and you're convinced by the idea before you buy that stock. Because there will become times when you're tested, your patience is tested. And if you haven't done that research, you will crack. But if you have done the research, you can stay the course.
Many thanks, Edmund. That's tremendous. Let's come back in the next episode to hear your stock picking criteria. But for now, thank you very much for your wisdom and guidance, which is invaluable. To find out more in this series and other educational videos or podcasts, please go to piworld.co.uk. See you soon.